What is fractional reserve banking? Fractional reserve banking catches a lot of people's attention because it artificially inflates the money supply, which devalues the currency you hold. And the reason why banks do it is because they profit from collecting interest from loans. So what fractional reserve banking is when banks hold a fraction of the money you deposit, which is called the reserve, and lend out the rest. And the reason why banks are able to do this is because a lot of people keep most of their money in the bank. They don't often all withdraw large amounts of money from the bank at the same time, which is why banks can just keep a percentage of the money people deposit in reserve in case people need to withdraw money and lend out the rest so that they can profit off of collecting interest from these loans. So let's illustrate with an example. Let's say person A deposits $100 into the bank, so his bank account has $100. And let's say this bank's reserve requirement is 10%. So the bank is required to keep 10% of people's deposits in reserve, and they can lend out the rest. So let's say this is what the bank does. It keeps 10% of person A's deposit, which is $10, and lends out the rest, which is $90. So let's say the bank lends $90 to person B. So person B's account now has $90 extra. So already we have a $100 deposit turn into $190 in the economy, in the money system. So that is what a lot of people feel is controversial about fractional reserve banking, because they say that fractional reserve banking is creating money out of thin air. But this process continues. So person B's account has $90, and let's say the bank keeps the required reserve, which is 10%, so $9, and lends out the rest, which is $81. So the bank lends $81 to person C. So person C's account now has $81 extra. So this $100 now becomes $271 in the money supply, in the economy. So the bank is again creating more money in the economy, and this process continues and there's more money created. So how much money is going to come out of this $100 deposit in this example? So we can use a summation to calculate this, and this is a geometric series. So we will have this summation, and the ratio is 0.9, and the starting amount is 100. So you can use the formula for the summation of a converging infinite geometric series, which would be 100 over 1 minus 0.9, which would be 100 over 0.1, which would be 1,000. So this $100 deposit that person A deposited through fractional reserve banking and through a reserve requirement of 10%, and assuming that the bank actually follows this reserve requirement and lends out the rest of the deposit, you have $100 deposited into the system become $1,000 circulated in the economy. So that's $1,000 in the money supply out of just $100. I would like to clarify that borrowers often spend the money they borrow. They don't often keep their loans in bank deposits. Otherwise, they would not need to take out loans. But this does not change this example at all, because whether or not person B or person C or some other borrower spends most or all of their loan, that money will still end up with someone else, and that money will still end up at the bank. So this example still holds.